The shift in the jobs to openings ratio, where the number of unemployed people has now exceeded available job vacancies in the United States for the first time in years, marks a significant turning point in the labor market with profound implications for both the economy and society. For much of the last decade, especially since the economic expansion following the Great Recession and again after the initial COVID-19 slump, the U.S. labor market was marked by robust demand for workers, leading to a prolonged period where job openings consistently outnumbered job seekers. These dynamics contributed to competitive hiring environments, rising wages, lower unemployment, and a strong sense that the market heavily favored workers. However, the landscape has shifted dramatically in recent months, as recent data shows job openings falling well below the level of those seeking employment, signaling a softening labor market and the need for structural adaptation at every level. In the years preceding this change, especially 2021 to 2022, the labor market was in a period known as the Great Resignation. Many workers voluntarily left their jobs for higher pay, better benefits, or improved work-life balance, emboldened by a near-record number of available positions. Job openings per unemployed person regularly exceeded 1.5, sometimes even crossing the 2.0 mark. Employers responded to this climate by raising wages, improving benefits, and aggressively expanding recruitment efforts, particularly in sectors like hospitality, retail, and healthcare. The COVID-19 pandemic also accelerated transformations in remote work, automation, and skills requirements, while creating short-term hiring surges in technology, logistics, and delivery services. As the recovery advanced, Federal Reserve officials warned that a persistent imbalance where job openings far outnumbered unemployed workers was contributing to wage inflation and general price increases nationwide. By early 2024 and into 2025, signs of a labor market slowdown began to accumulate. Job openings began to drop from their pandemic and post-pandemic highs, falling from nearly 7.8 million in mid-2024 to just above 7.1 million by July 2025, according to Bureau of Labor Statistics data. Unemployment, which had been at historic lows, gradually ticked upward, reflecting weaker hiring, especially in manufacturing, retail, and sectors sensitive to global trade policy. Analysts attributed part of this shift to several factors: tighter monetary policy from the Federal Reserve seeking to tame inflation, extensive tariffs and trade uncertainties that led some companies to hold off hiring, and stricter immigration policies that reduced the supply of new workers. Consumer spending also began to slow, further reducing demand for labor in consumer-facing industries. An important milestone was reached in July 2025. For the first time since the early pandemic shock in 2020, there were fewer job vacancies than unemployed individuals, with just 0.99 openings per job seeker, down from 1.05 a month prior, and the first dip below 1.0 in over 4 years. Despite the decrease in worker demand, layoffs have stayed relatively stable, while the pace of job switching has slowed, suggesting a labor market in transition rather than experiencing severe disruption. This new balance, or even reversal, is described by economists as a natural adjustment after years of overheated wage and hiring growth, and is likely to moderate further inflation. The Federal Reserve's response, potential interest rate cuts, and continued monitoring reflects the growing risks to broader economic stability. Looking forward, the labor market will likely continue to evolve amid various pressures. The U.S. Bureau of Labor Statistics projects total employment to grow over the next decade, with significant gains driven mainly by the healthcare and social assistance sectors. However, new job creation will be offset by significant structural changes. Advances in automation, the growth of artificial intelligence and green technology, and shifting consumer preferences.
According to projections, between 2025 and 2030, up to 22% of today's jobs could undergo transformation or displacement, with net growth resulting primarily in frontline roles, such as delivery, agriculture, and education, while technical and green economy jobs are set to grow faster still.
Policymakers, businesses, and workers must respond proactively to these challenges. Education and workforce development programs will need to focus on digital skills, adaptability, and lifelong learning to enable workers to transition into new roles. The government may increase investment in reskilling and unemployment support, while the private sector rethinks hiring and retention strategies. Immigration policy, wage setting, and trade agreements will also play major roles in shaping the labor force. Economists predict that as the ratio of jobs to openings normalizes, or even reverses, wage growth will moderate, and economic inequality could increase if the transition is poorly managed. In summary, the reversal of the jobs to openings ratio after many years signals the end of an era in U.S. labor market dynamics. Before this, workers enjoyed bargaining power and abundant opportunities. But now, the market is entering a period of adjustment, requiring coordinated strategies and long-term adaptation. The future will be shaped by technological shifts, demographic trends, policy responses, and the ability of both businesses and workers to respond to new realities.